Hey, what's up everyone, and welcome to the School of Personal Finance. So it was a little over 2 months ago that I posted a video called The Story of My First Rental Property. And I received so many questions from that video. Questions like, how do I calculate the return on investment to know if it's a deal that I want to invest in or not want to invest in? Then, what do the numbers look like today compared to when I was first purchasing back in 2016? And then last, questions like, do I currently have any strategies that I'm implementing, like any cash out refinances, or am I still buying in this environment, or maybe even selling? So in this video, I'm going to go through all that. I'm going to show you exactly how I analyze the numbers. I'm going to talk about my thoughts on the current environment right now, and also why I'm actually considering selling one of my properties. Let's get to it. All right, so I'm going to start off with showing you the numbers, showing you how I analyze a property to see if it makes sense for me to invest in it or not. And I'm going to show you an actual example from a property that I bought at the end of 2016, which I am currently debating if I should sell it or not. And now this is a different property than I talked about in the first video that I did. And just a quick refresher, the purpose that I invest in real estate is for income. I'm not speculating on appreciation. I'm not buying on the coasts, hoping that I'm going to catch a nice upswing in the market, which would have been a great idea to do a decade ago because I'd be very wealthy right now. But I'm investing in the Midwest where you could buy a property, between 100 and 150 grand, and you could earn a cash flow from it after all of your expenses. So that's where I'm focusing on, and that's what I'm about to run through the numbers, how to analyze those types of deals. And I'm buying turnkey properties. So there's no rehab money. I'm buying it basically retail, but it has a new roof, new HVAC, everything's new in there, so I don't have to make any big improvements to it. I'm not getting great deals on these properties. I'm not going in, I'm not flipping them, nothing like that. These are long-term buy and hold properties that, maybe not always they're going to be long-term, but that was the point in the beginning. All right, so let's get to it. All right, so the first thing that I calculate in my brain right off the bat, which is very simple, and by no means can you make a decision based on this, but it's just a starting point, and that's what we call the 1% rule. So if you buy a home for $150,000, you want it to rent for close to 1% of that purchase price. So 150 grand, if you could get $1,500 in rent, that would be great. That would probably mean that it's going to have a nice cash flow left over after all of your expenses each and every month. Now, in 2016, this was much easier to find compared to where we are in 2020. So this home that I'm about to go through the numbers with, I bought this home back then for $140,000. And the first tenant that was in the house, it rented for $1,395. But I think that they pushed the market with that first tenant, because the next tenant that I got in there, it was $1,325. So the rent actually went down. But that's the first thing that I look at, is can I get close to that 1% rule? 4 years ago, you could get over 1% in certain markets, and I did on a house or two in Kansas City. Memphis, I was able to get over a 1% rule rent on there, but these days it's just harder to find that. All right, so once I know the purchase price, I know what the rent amount is, and the rent amount, don't just go by what people say. The best thing to do is to do some research and to call some realtors and ask them, I'm thinking about buying this house. If you were to rent it, what do you think I could get for it? What if you were to list it, what would the rent be? That's the best way to get a real idea, and to look at, comps in the area, what they're currently renting for. Another number that I'll look at right off the bat are the property taxes. In an ideal world, if you could buy a house where the property taxes are like 1%, 1.5% of the purchase price, that would be great. Then it's not going to eat into your cash flow too much. But states like New York, California, even Texas has higher property taxes where you need to get a higher rent to be able to make up for the additional cost in property taxes. So on this house, the taxes, they're right around 1.5% of the price of the property. So that was a good sign. So we move forward. So $140,000 purchase price. Now, I know that I'm going to be putting 20% down. So I'm going to get an 80% mortgage, put 20% down. So I know that I have $28,000 that's going to be coming out of pocket. And then we have closing costs. So closing costs could vary. I try to estimate on the high side. But on this property, they were a little bit over $4,000. So I'm all in a little bit over $32,000 to purchase this property. And then next, we need to calculate how much monthly cash flow could I expect if everything runs nice and smoothly. So for the rent, I'm going to use $1,325 because that's really what it ended up being over the next 3 years after that first year. So now we have to deduct all of the expenses off of that rent. So for property management, I have 8% that I pay to a property manager to manage everything with the property so I don't have to deal with anything. What I really do is manage the property managers. The property manager, they're managing the tenants, they're screening the tenants, they're doing all the dirty work for me. I just have to manage the property manager and make sure that everything's going smooth. So 8% per month of the rent I pay for property manager. Then after that, I have my taxes. So here are the taxes, they come out to $176 a month, and that is escrowed into my mortgage payment. I break it out here just to show the line items, but that's included in my mortgage payment. My homeowner's insurance as well. I escrow that in my payment, but it's $70 a month. And then we have my mortgage payment. The principal and interest is $559 per month. So the total amount that's actually coming out of my bank account to pay my mortgage is the $805 per month. So that includes principal, interest, taxes, and insurance. All goes to the mortgage company each month. So after those expenses, that means I'm actually getting $414 every month direct deposited into my bank account. But the expenses don't stop there. I still need to take some of that money and put it aside for things like vacancy, because there's going to be times when the property is going to be vacant. If you have a turnover, if you have a tenant that leaves, it might take a month to get everything back in order and get a new tenant in there. It could take 2 months or 3 months. This is another reason why it's so important to pick a market where you have a high percentage of the population that are renting, so that there's a big pool of people to choose from so that you could get a great tenant in there. And then you also have to put money aside for repairs, because there's going to be things that go wrong, and then also for what we call capital expenditures. And these are bigger items, like if you need a new roof, if you need a new HVAC system, if you need to replace windows, carpeting, flooring. Those are all considered capital expenditures. So you want to put money aside for each of those things, because even though they're not happening right now, they're going to happen in the future, and you have to be prepared for them. So the numbers that I typically use for vacancy in these markets, I use 5%. And my experience, it's been about that. So in this case, that comes out to $66 a month that I need to be putting aside for when I eventually have an empty house with nobody paying me rent. And then I use that same 5% for repairs. And then for capital expenditures, I only use 3%. And the reason for that is because I'm buying these homes with everything basically new. So I know that a roof is a very long way away because they just put a new roof on the house. So total for vacancy, capital expenditures, and repairs, I'm using 13% of the actual rent that I collect every month, putting it to the side for when that stuff comes up. So on this home, that's a total of $172, leaving me with a net cash flow of $242 every month in my pocket that I could go spend however I want. So one of the questions that I received from a viewer was, what's the minimal amount of cash flow that I'll accept to make an investment in the property? And it really depends. It depends on the market. So like, for example, Kansas City has seen a lot of appreciation. And like this house, for example, this is what we would call like a B+, A- neighborhood. It's a nice neighborhood where there are nice homes and there's a better chance of appreciation. And this house has appreciated. So if there's a better chance of appreciation, I'm willing to accept a lesser cash flow compared to a market like Memphis, where I know that I could get a higher cash flow, but the appreciation, it's not the same. You don't have the same chance at as high of appreciation as you do in Kansas City. All right, so now that I know that I'm going to be putting $242 of positive cash flow in my pocket every month, the next thing I want to calculate is my return on investment. And we call this your cash on cash return. So to buy this property, I need to put up $32,540 to purchase it. That's my 20% down and my closing costs. And I'm going to be getting $242 a month in return. So to calculate the cash on cash, I need to annualize that. So $242 a month times 12 months, so that's $2,904 that I'll be getting return on investment each year. So if I just take that number and I divide it into my out-of-pocket costs, that gives me my cash on cash return, which in this case is 8.92%. So now I could look at that and I could compare that to other investments that I could make. If I invest this $32,000 in the stock market, if I invest it in a CD at the bank, whatever I invested in, at least I have a number now that I could kind of compare it to. And now remember, there are other ways that you can make money in real estate, like for example, the appreciation of the house or the tenant paying down the mortgage, the tax deductions. And I talked about that in a video I did a while back called The 5 Ways That You Make Money Investing in Real Estate. I'll put a link to that in the description below. But for this, we're just calculating the cash on cash return. All right, so now I'm going to talk a little bit about my opinion and what I'm currently doing with my own portfolio, if I'm buying or selling or what I'm doing. So now before I get into that, my disclosure, don't listen to me. I don't know anything about you. I'm not giving you any kind of personal advice. Just because I think that the housing market is doing one thing doesn't mean that that's what it's going to do. If I'm buying, that doesn't mean it's right for you to buy. If I'm selling, that doesn't mean it's right for you to sell. So this is just for educational and entertainment purposes only. All right, so with that said, the housing market, it scares the crap out of me going into 2021. There's a lot of variables right now. So the housing market is red hot. Prices are high right now. They are soaring. In my area, you put a house on the market, by the weekend, you have multiple offers above asking price. It is very competitive out there. But the main reason is because there's very low inventory. There aren't many houses for sale. So the coronavirus, it stopped everybody in their tracks. People are waiting to see what happens with their job, what happens with the economy. Nobody knows where we're going to be. And then in 2021, if we don't get more stimulus, if landlords are allowed to evict tenants, if banks are foreclosing, there could be a ton of new, fresh inventory hitting the market, and that is going to make prices go down. So I am nervous about this market, and that is leading me into the decision that I'm thinking about selling this house that we're talking about. And it's for multiple reasons, but the biggest reason is because this house has performed very well over the last 4 years. So it has appreciated a lot. I've been talking to realtors in Kansas City, deciding if I want to sell this house or not, and they're throwing numbers at me like I should be able to sell it in the ballpark of $220,000. So even if we say that I could sell it for $210,000, I bought it 4 years ago for $140,000. So that's a 50% price increase over 4 years. That's a big number. And when we just went through this calculation of all these different numbers that I use when evaluating a deal, if I were to evaluate it at a $210,000 purchase price, it doesn't make any sense. There's too much equity in that house that's sitting there, where I think that the right move might be to actually pull it out and invest it somewhere else. But honestly, I'm not going to invest it anywhere just yet. I want to have some cash on hand to see what happens in this next year coming up. I have a feeling that there's going to be investments out there that are going to be much cheaper than where they are today, and I want to raise cash. I'm in that mode right now where I want to have savings, I want to have security, I want to have cash in the bank, where if we do have a big dip, even if it's in the stock market, if it's in the real estate market, wherever it is, I want to be able to go in and have dry powder to pick up some things on the cheap. Now, I'm not putting all my eggs in that basket. I could very well be very wrong. So selling one house is not going to be a huge deal. And when I look at the portfolio of houses that I have, this one makes the most sense because it's had the most appreciation. If I sell that house, I'm going to have to pay taxes on the gains, which is not insignificant. So I got to put that money aside for taxes. I have to pay the mortgage off. So I still think that I owe somewhere around $105,000 on that house. So I'm going to have to satisfy the mortgage note on there. And then the money that's left over, I'm going to stick in the bank and see where this next year takes us. But it's a recommendation that I have for everybody out there right now, is to tighten up a little bit, to be safe, secure, have some money to the side just in case, things go south, and you can have some dry powder to go in and invest with. So that's my thoughts with everything going on. That's why I'm thinking about selling this property. Really depends on your situation. Again, I'm not bailing on the real estate investments, on the housing market. I still have the other houses where if we continue this upward swing, I'm going to participate in it. And maybe I'll look back on this and say, you know what, it was pretty stupid to sell that house. But right now, the numbers don't make sense on it anymore. So I think it's time to pull the trigger on it. I hope that you found that helpful. Please leave a comment down below. Let me know if you think it's a good idea to sell this house, to not sell this house, what you would do if you were in my situation. I would love to hear about it. And I will see you guys again next week with my next video. Please make sure to subscribe to this channel if you have not done so already, and hit that like button. See you next week. Thanks.